Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McLean, thanks for joining us.
Glad you're with us today as we're talking about financial matters. We got a great program lined up for you. In addition to taking a couple good calls, Apollo Lupescu is going to be joining us. He's kind of the master of explaining complicated financial matters in everyday terms, and he'll be talking a little bit about tariffs and the markets.
Yes, we don't have a lot of guests outside of the organization on the program, but I do like Apollo.
Certain ones I like.
I do like Apollo.
Yeah. So it'll be a good show, so don't go anywhere.
Yeah, yes.
Or if you're going somewhere, have your AirPods, headphones, whatever.
Or your talking little phone, as my wife calls it. I have to turn it off when she comes in the room. I listen to a lot of podcasts when I'm around the house.
Oh, well, that's nice. To give her your attention.
Yeah, maybe.
I don't like they like the Apple Watches because you're talking to someone and they look at their watch. They're looking at the text messages coming in. Like, can you not?
Oh.
I was just noticing at the gym this morning, almost everybody in the middle of their weights that they're there and they're sitting there on their phone. And
That's why I don't go to the gym.
Good. It's a bad place. It's hazardous to your brain.
It is. So I wanted to, Scott, I read this article this last week, 2 weeks ago in the Wall Street Journal, and I had no idea.
Now you're just showing off, reading the Wall Street Journal.
I do like the Wall Street Journal.
I do too.
Some of my fondest memories are actually reading the Wall Street Journal in different locations.
What? Like your fondest memories?
We were down in Yosemite with the kids when they were younger, and what?
Hey, there's Yosemite Falls. Hey, I'm busy reading the Wall Street Journal, kids.
No, we had been hiking all day, and we brought them down to the creek, and then the little creek, and I brought a lunch.
That's one of your fondest memories, reading the Wall Street Journal in Yosemite.
That does sound pretty strange.
Oh, it does, Pat. Yeah, beyond strange.
It was I went down.
Don't you want to unplug when you're in a place like Yosemite and kind of think that this is life forever, and this is,
Okay, so I took my lawn chair down there and the kids, and we brought them down to the little creek, and they were swimming around in it and playing in the creek. And I brought
the happiest day of my life.
I brought 2 ice cold beers down there, sat in the lawn chair reading the Wall Street Journal where the kids were. It was idyllic. That is
everything except the Wall Street Journal sounds idyllic at that point. Okay. I like the concept of a hike and the kids swimming and sitting on a lawn chair drinking a beer in Yosemite.
Anyway, I was reading the Wall Street Journal, and article, obscure Chinese stock scams dupe American investors by the thousands. And I thought, what a strange world we live in that we allow Chinese companies to list on our exchanges, right? Oftentimes they have no real.
Why would you buy some obscure Chinese company?
Okay, so this is, but
you're a partner with the Chinese Communist Party.
Yes,
all those businesses.
So the story of Braden Lindstrom. He was encouraged by someone impersonating a financial advisor to buy shares in a small Chinese company listed on the NASDAQ. A few clicks later, he was on his way of being scammed out of $80,000. Not just $8,000, $80,000. And so this gets worse. He's a college professor in Utah.
Hopefully not finance.
And he bought Jiayud Global Logistics, a small Chinese company. And the stock went up and up and up, and then it went to close to zero.
Is it just some pump and dump scheme?
It's an old-fashioned pump and dump. That's all it is.
You just get some people pump up the stock, make it look like there's all this demand for the stock. Price goes up. Investors get excited. They buy. Price goes up. Investors get more excited. They buy more. Then the early people cash out.
Yes. And
the stock collapses.
You know what's funny is people look at the price of a stock on these small things, but they should be looking at the volume.
At the same time. Yeah. Why is the price going up?
Why is the price going up? Because if it's a low volume,
that's
and
right.
the stock
There's no
price
volume
is
and all
going up.
That's right.
It looks like a pump and dump scheme because someone does a bid and then there's an ask and those prices are agreed on. So and primarily what they're using is social media to get to these. And they're example after example in this. And this just reminded me how life is just like a big circle where these were the pump and dump schemes that when I entered the industry in the 80s, this was a thing.
Yeah, there'd be boiler rooms.
Boiler rooms. In fact, there was a movie called Boiler Room.
I don't know, was this pump and dump stuff?
Those were all pump and dump schemes. Yeah. So let's just leave it at this.
What I find even more fascinating, Pat, is not the fact that there's people out there trying to scam other human beings, as sad as that is. That's part of humanity, and we all deal with it on a daily basis with all kinds of different stuff we get thrown our way. But the fact that people actually are fine with having their story listed in the Wall Street Journal. Hey, here's how I got scammed. It's quite amazing to me.
Yes, and Mr. Lindstrom, the college professor, is one of 5 people interviewed by the Wall Street Journal who said they were fooled by advertisements on Facebook or Instagram that told them they should buy Jiayu Global Logistics. And many of these went back to Facebook and Instagram trying to lay blame on them.
The advertiser, what do they just...
Yeah.
They don't do... you can't expect these platforms to do due diligence on their advertisers.
Especially on these sort of where they don't know where a lot of the advertising is coming from. So yeah, I just share that with you because not only did I find it interesting that we have small Chinese stocks being listed on a NASDAQ, that people are getting scammed, so stay away.
Yeah. Hey, we got a great guest right now, Apollo Lupescu, and we had Apollo on before the elections to talk a little bit about the elections and markets and
the correlation between Democrats and Republicans versus how the markets.
Yeah, that's right. And Apollo is one of these guys. He's part of Dimensional Fund Advisors, but he's probably the best I know about taking complex financial matters as it relates to the markets and put it in layman's terms. And I think the real benefit there is helping people stay invested during market cycles when their emotions are telling them something different. So,
in fact, we had him speak at our national conference where we bring all our advisors in Dallas. And by the way, Apollo, I have been to hundreds of these things. Your talk about the resilience of American business was great, and it just reminded me that whatever the world throws at American business, their job is to overcome.
Yeah, so you're gonna share a bit today on tariffs and the markets and that sort of thing, right?
Absolutely. Well, first of all, thank you so much for the invitation to be part of this, and also for the invitation to the conference. It was great fun for me. And you're absolutely right. I mean, we do live in a country that is built on free markets, and companies are incredibly resilient because people are resilient. And as much as people are pessimistic about what might come next, the reality is that companies have always faced challenges. And over the course of our history, they've been creative. They've been innovating, and sometimes these crises have produced opportunity. So I'm confident about the future, and that's a positivity that I think it's in my genes somehow.
Well, it's really interesting, Apollo, when you look at Liberation Day, when Trump came out and said he's going to slap tariffs on everybody, and the markets tanked, and we essentially, I think we had an intraday bear market on the S&P 500. We hit 20% intraday, and then maybe I'm off, but somewhere close to that, and then everything's recovered, and then we went on to new heights, but that doesn't seem like the tariff issues resolved itself.
No, it's not, and it's a big issue right now. And what I found too is that some folks know the term tariff pretty much like a jargon. Not a while ago I went with my dad to the doctor, and he found out he has some issues with the pancreas. And I'm not a doctor. I'm not an expert. I mean, I have some general education, and I know it's in my body somewhere. It does something, and I don't know exactly what. But it was interesting for me because the doctor was very nice at explaining what it does. And for a second, I felt like, should I know this? And then I realized, no, it's not my profession. That's why I go to the doctor. And even though maybe it would be nice if I knew, I'm not required to know. And I find in the context of tariffs that this is a word that we understand as advisors, as economists. But I found that for a lot of folks, it's a bit of a mystery. And a lot of times they get the definition from whatever news outlet they might be listening to or watching or reading. And I'm wondering if it's worth for like a couple of minutes just making everybody clear on what exactly is a tariff. How does it work? Because from there, you kind of get a sense of the impact that it might have on us as consumers and businesses and the market as a whole. Is that
yeah, please, yes.
Yeah, and I'm going to use something that.
And by the way, I would be shocked if the definition of tariff is different on MSNBC than it is on Fox News. But anyway, there we go.
You think? All right, so let's make some sense out of tariffs and what exactly are they? How do they work? And I'm going to use an example that is near and dear to my heart. I'm not Buddy the Elf, but I do put maple syrup on a lot of things, maybe not spaghetti. And I had it this morning on my yogurt. So I love maple syrup, and I buy
hilarious.
I buy it at Costco. That's where I go get it.
By the way, Apollo does not look like the kind of guy who loves maple syrup. He looks super fit.
Well, I actually love the fact that you could work a Buddy the Elf reference into an economic talk.
Who would have thought? So in the good old days before tariffs, Costco would need to buy maple syrup, so it would sell it to me, and they would go to the Vermont producers and say, "Can I buy you maple syrup?" And those folks would say, "Sure, I'll sell you the maple syrup." But it turns out there are not that many maple trees in Vermont, or at least not as many as perhaps across the border in Canada. And Costco would also go to the Canadian producers and say, "Hey, friendly Canadian producer, do you mind selling me your maple syrup?" And those producers, they say, "Sure, I'll sell you the maple syrup," and just come up with a number. Let's say it's $20 a bucket of maple syrup. Costco would then take it for $20, and then it would add a few dollars for their warehouse, the employees, the electricity, their profit margin. Let's say $5 for the sake of the example. So between the $20 they pay the producer and the $5 they added, Costco, I would go pick it up for $25, and I'm a happy camper. I love it. Everything's great. But now the president comes along and says, we're going to impose 25% tariffs on all products coming from Canada, and let's say maple syrup is included in that category. Well, how does it work now? Well, the legal burden of paying that 25% of the value of what gets brought in the country, so 25% of $20 in this case, it's $5, it is on the importing company, in this case, Costco. So Costco is legally responsible now to pay $5 to the U.S. government right away as they bring in the $20 worth of maple syrup. Now, where is that $5 going to come from? That's the question. Well, one thing that Costco can do is go to those friendly Canadian producers and say, listen, would you mind selling me that maple syrup for $15 instead of $20 because, I have to pay the government $5. But those Canadian producers are saying, wait a second, no, I'm not going to do that. It's, that's what it costs me to make. I don't make as much money on it. And by the way, where else are you going to get maple syrup? It's not like you can plant a tree and quickly get maple syrup. No, I'm going to stick with my $20. Well, Costco then obviously doesn't have any other place to get it. So they say, fine, I'll pay the $20. And then they bring it in and they still have to pay the $5. Well, the second option is that they send the government the $5 that they would keep, but that doesn't make it like a viable business. So that's not realistic. So what's the third option? The third option is that Costco would probably need to increase the price and take the additional dollars from us, the consumers, and send that to the government. So in this world of tariffs, there are three parties involved: the producer, the importing company, and the consumer. And who pays the tariff is unclear, because even though legally Costco is responsible for paying it, it turns out that it's more complicated, because in some cases they could go to the producer and the producer might say, well, yeah, sure, I'll take a little bit of I'll drop my price a little bit. But here's what we found out of the first Trump administration when they imposed a 20% tariff on washing machines. there was an economic report written afterwards, and what they found is that 12 out of the 20% of the tariff was passed on to consumers in the form of a higher price. And the rest were haircuts taken by the producer and the importing company. So, everybody kind of took a hit there, but the bulk of it in the case of those washing machines was paid by the consumer. So it's a form of a tax that it's not collected through the tax forms at the end of the year, but rather it's collected and paid by the importer. But it is possible that the consumers might bear the burden of this tax if the importing and the producing companies don't take a hit. So it is, again, interesting because when you hear about inflation perhaps coming back, it is likely that in some cases, not in every case perhaps, but in many, many cases when there is not an easy substitute and everything is pretty much made abroad, there's little incentive for the producer to cut their price. Where else are you going to get it? And in that case, we might see higher prices, perhaps fewer selection in stores, and perhaps lower quality because of these tariffs. And again, it depends on product by product. It depends on where
Apollo,
things are made.
Apollo. Yeah. So it's a consumption tax. If I was Costco,
that's what it is.
It's a consumption tax. If I was Costco, do I lower my margins or I keep my margins the same? So therefore, the net profit actually that goes to me as Costco actually goes up.
And that's the thing. Like Costco is a pretty unique example, and I just happen to know that the margins at Costco are capped at about 12 to 14%.
Yeah, 12 on their own on products that are not Kirkland brand, and 14 on Kirkland brand products.
Exactly right.
We get mail. We get my wife has her own parking spot at Costco.
We all do. When you spend $10,000 a month, you remember your name. I love that.
I have a bunch of kids. So do they keep the margin? So Costco, they would keep the margins the same. So therefore, their net profit would actually go up with the tariff.
If they do that, and Costco has been, again, it's absolutely possible that they do that. They also have to realize that there's a price-sensitive consumer out there, and if they keep the price too high, then it's possible that they might lose sales. So it's a very interesting dynamic. But by and large, what we do find is that these companies like Costco, for example, or other companies, they're trying to make up the lost revenue in other ways. And we were finding that, for example, if you go online and you buy things, some vendors might not give you the free shipping, and it's a way to make up for the lost revenue or make up the tariff that they have to pay. And in the case of the washing machines, well, what do you buy with a washing machine? A dryer. And dryers were not subject to tariffs, and yet their price goes up. That went up as well. So it is interesting that companies will try to figure out perhaps how to maintain their margins in other ways. But ultimately, guys, what a lot of economists are realizing that a bulk of this tariff for a majority of products is likely going to fall on the consumer. And that's why we're hearing this. So from a company perspective, you see that these folks are trying to negotiate and try to figure out, how do I keep my margins? And I'm not saying they're going to make more money, but they're going to try to figure out, how do I maintain an operating profit? And again, it's going to that tariff has to come from somewhere, and it's quite likely that maybe directly or indirectly consumers will pay for it, and that's why you might hear about the potential for inflation.
So why didn't we see a bigger inflation bump on this last inflation report?
I mean, it's interesting because I don't want to get too specific in the economics of it, but a lot of firms have been stacking up in expectation of these tariffs, and there's a pretty decent supply that's in warehouses, and when that expires, there's a good chance that the much lesser volume of trade. I mean, I think 30% less ships came into the ports in the U.S. That's going to be reflected at some point, because there's no magic. I mean, we saw the same thing in the pandemic. If you don't bring in stuff and people want to buy it, again, you're going to have fewer choices, higher prices, and perhaps lower quality. Now, with that being said, I do also want to touch on this. Like, why would the government want to take money away from the public? Because that's basically what you're doing. And I have to say there are three reasons, and then people kind of point to, like, why there's got to be a reason for that. And the first one is revenue. And going back to 1776, what's fascinating is that in those days when the country was formed, about 80% of the government's revenue at the federal level came from tariffs. Nothing unusual. I mean, we took 80% of the government revenue from tariffs back in those days. And it wasn't until about the Civil War when we introduced the income tax, and the income tax over time became the primary source of government revenue, to the point where last year tariffs were only roughly about 2% of the government revenue. So we went from 80% to 2%. So the tariffs are not a big part of our budget, and not at all. They're relative to everything else. So the revenue is one reason that we hear the government saying, but again, this is revenue coming from us, the consumers, which I'm not sure that's necessarily something to be trumpeted. The second thing is maybe we want to protect and restrict access so some industries in the U.S. Would be able to continue to operate, and it could be for strategic reasons, or it could be to protect jobs. And I've traveled the country, and there's no doubt in my mind that has been devastation in some parts of the country because of trade and maybe jobs being shipped abroad. And there's no doubt that between the Civil War and perhaps World War II, there was a major reason why we saw a lot of these tariffs being put in place. Did they do a good job of protecting jobs and adding? Again, it's a really mixed bag, really hard to say. But what we can say, even if those jobs were kept or created in the U.S., it came at a very big cost to society, because we all ended up paying more. And, you might save some jobs in steel, for example, by putting tariffs, but you might lose other jobs down in washing machines because you're less competitive now. So it's really a mixed bag on that. And thirdly is that perhaps there is an idea of reciprocity, that if you are, charging me a certain tariff, well, it's only fair that I charge you the same. And that's, again, being invoked these days as well. And it's legitimate in some ways. I think every country has something that they want to protect. And in other ways, over the past 80 years after World War II, we've championed a reciprocity that was driving tariffs to zero. Like, what if we have free trade? And that has been sort of the economic regime of the last 80 years. And a lot of companies have built their production lines and supply chains on this idea that we can move goods freely among countries. And this sort of pivot on a very short notice, it's creating really big headaches. Again, they're commenting on trying to figure out how to negotiate them, but it is a huge headache if you've had 80 years of a certain regime that's being kind of flipped over overnight almost, and you're going to well, what do I do now? So it's really creating a lot of disruptions and
well,
and I know, again, I mean,
but Apollo, but some of these, let's say the tariffs actually work, right? And we're in
work in what?
Well,
one of the three.
well, we're ignoring a couple things. One is environmental. Regulatory environment in which we work, right? We export a lot of our pollution. I mean, California is the best at it, right? We don't.
That's right.
We don't
There's
do
tons
it
of
here.
oil here. Yeah,
but
don't
I'll
drill
buy
here.
the products
That's right.
that actually. Oh, and not only that, we're going to export them to a place that doesn't have any environmental regulations that we have. But
do you remember the book, The Lorax?
Yes.
Yeah, I mean, I remember reading that to my kids, and that's kind of what I felt like. Absolutely, some other country can make money, and they might not have truffle trees, but hey, at least they get some money.
Yeah.
But I think it's even for sure that's been an issue. But I think it's even more fundamentally.
Wait, I got to stop you for 1 second. So we're all in the same thing, Buddy the Elf and a Dr. Seuss reference. How old are your kids?
When he said Lorax, and I thought, he's not talking about Dr. Seuss.
No, he's
Is some other
100% talking about Dr. Seuss. How old are your children?
Well, one of them is 18. The other one is 22 almost.
Okay,
but I keep reading them. I keep reading them at night. I can read the books.
Yeah,
Okay, all
Hey,
right.
kids, I'm going to tuck you in.
But in terms of national security, right? We can't ignore the fact that we won. A large portion of the reason we won World War II was because of our manufacturing prowess and how quickly we were able to actually turn that on.
Yep.
but the stuff from getting from concept to implementation, is it even possible now after 80 years?
That's exactly the question. You got it right. I mean, I think that what helped us in those days was, again, it's the ability of companies to be creative. And, you saw companies like Ford and GM, where they were not making cars, but they retooled their lines to make tanks and planes. And that's just something that we did on the fly because of this ingenuity of the American people. And you saw that in the pandemic. Yeah, we didn't produce that many respirators at home, but all of a sudden Ford can go and make them. But I think there's a fundamental reality that we're too far along to be able to put that back in the box. I mean, that ship has sailed, in my opinion. And I'll give you a quick example. NVIDIA is an amazing company that designs chips, and it's the poster child of American success in artificial intelligence. Great, but what they do is basically design the chip. So they're like some pastry chef who developed the recipe for the best cookies in the world. So they know that they have the recipe for the best cookies in the world. The thing is, they don't have a kitchen. NVIDIA doesn't have any manufacturing facilities. And what gets even more interesting is that to produce their most advanced chips, there's only one single company in the world that over decades had developed a system to be able to do this thing called lithography and process these chips. Nobody else in the world has been doing it. They have this amazing engineering base that, again, over decades, and that company happens to be in Taiwan Semiconductor Manufacturing Corporation. It's the only kitchen where NVIDIA can bake their cookies. And what's even more interesting, in that kitchen, you need to have an incredibly specialized oven. And that oven is that machine that TSMC uses. It's a science fiction machine. If you shoot a laser from your house to the moon, it would hit a ping pong ball. It's incredible. Like it prints transistors the size of 10,000 times smaller than the human hair. Not you and I, but people who have hair. And it's science fiction, and it's a global supply chain. And in the world, there's only one company that over decades has been able to produce that machine. Nobody else can even get closer. And that company is based in the Netherlands. It's called ASML.
Yes, so and those machines are hundreds and hundreds of millions of dollars.
Oh, yeah. They're like a quarter of a billion.
On a complete side note, if you own NVIDIA and this is news to you, maybe you should not own NVIDIA. Anyway, continue on.
Well, I mean, it's as long as there's a global supply chain and global trade, a global value in that respect. AI to function the way we know it, in order for NVIDIA to be this incredible success story, we do need these partners. And is it realistic to say that somehow TSMC is going to pack their bags and move all their Taiwanese engineers and their families to Arizona or Nevada? Is it realistic to say that ASML is going to pack their bags to the Netherlands and move everything to the U.S.? And then those supplies, those parts that these companies use, they're all going to somehow be based in the U.S. I think it's just complete. To me, it's unrealistic. I cannot imagine that happening anywhere anytime soon or anywhere close to the same level of quality. So to me, what are we trying to do? It's a big question that I'm not sure that most people that I've talked to, most economists, have a good answer. Perhaps there's a greater wisdom, and at some point it'll be revealed to us. But I'm not here to make political statements. I'm a proponent, and I think a lot of us on this call are proponents of free markets. What has gotten this country so far is the ability of companies to operate freely. And I think that the less government intervention, the better. I mean, we've always kind of seen that free markets do a good job. And there's got to be some tinkering and regulation, but ultimately, it just feels like this is interfering with free markets in some way.
Well, Apollo, but was not the CHIPS Act giving money to Intel kind of foolish, thinking that they would become with
hilarious?
They tried. Yeah, so
I'm a big proponent of government get out of the way. Let markets.
So will these tariffs stick, or is a lot of this bluff, or mostly reciprocal?
Yeah, and I think that's the question because again, I mean, I don't know enough about the inner workings of the politics in D.C. It doesn't seem like if you talk to most economists, I think that economically people would say that we are better off kind of resuming free trade. And if we do want to help those constituents who got hurt by global trade, there are much better ways than perhaps we've done so far. But harming everybody else in the process, families who maybe are living on the edge, it's not necessarily the clever. So will they stick? I think to a large degree, folks, here's what I think about. I think that what gives me optimism is that as much as some people might disagree, I think that we have incredibly strong institutions in the country. And if these policies work, if tariffs work, and we all want to work because it means that the society is getting better. We all have a better life. And if these policies work, then, less than a year and a half from now, we're going to reelect or elect the people who champion these policies. And if it doesn't work, and if that turns out to be a disaster, well, again, in a year and a half, the country has a chance to, kind of tell us how they feel. And we had that free election, 6 months ago or 9 months ago. So, that institution is still incredibly valid. As long as institutions hold, I think there's a great degree of optimism to be had. Because if they don't work, this is not something like the pandemic that we don't know what's causing it and how to deal with this. In this case, we've got to know it's a policy, and we've seen something like this in the past, and if things don't work out, we'll just go ahead and choose a different direction as a country in less than a year and a half from now.
And so, if you're a long-term, I think if you're a long-term investor, you can either focus on the immediate and think, "Oh my gosh, like what happens if this or that," or you can say, to your point, like it'll be a blip.
It will change if it doesn't work. That's actually That's in my mind. That's brilliant, right? As long as the institution is intact.
Absolutely.
And depending upon what side of the aisle you're on, you may believe that the institution, in fact, is not intact.
Okay.
Well, and that's the thing. But people will vote with their pockets and their wallets. There's no doubt in my mind, because we've seen this every election. And Democrats who are not happy about the economy, they might vote Republican. Republicans who are not happy about the economy, they might vote Democratic. So I don't think that there is such a strong affinity towards the party, irrespective of the economic impact on my life. No, I think that people will vote based on the economy. But I do want to touch on one other thing that is really important for this conversation. That so far we discussed on the impact on businesses and consumers, but the markets, and this is where it gets so interesting, is the markets reacted to tariffs because of the unexpected magnitude of and breadth of tariffs. So the market was a little bit, the market expectation was different, and when the expectation got readjusted, we saw the big drop.
Yeah.
But I do have to make two quick comments on this. Number one is that markets tend to price expected changes in policy before they happen. If they're surprised, you're going to see big market moves. Otherwise, if the expectation is in line with the new policy, the market won't move because it's already priced in that expectation. But the second big one, guys, it's really important. Tariffs are not the primary driver of market returns, particularly over the long term. And to see this, look at the first Trump administration. We had 4 years of talk of tariffs, trade wars, blah, 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 all the things that we're kind of dealing with right now. And if you look at those 4 years, $1 invested in the S&P 500, the measure of the U.S. market, for the time that President Trump was in the White House for those 4 years, it actually went up by about 80%. So a dollar would have turned into $1.80, so which is a really nice growth over 4 years. Well, here's where it gets interesting, is that the country that we targeted, the country that we imposed the tariffs against, and really picked this economic fight, if you want to call it that way, was China. And over the exact same 4 years, the Chinese stock market did not go up 80%. It actually went up 100%. It outperformed the U.S. market and doubled in value. And if tariffs were truly the primary driver of market performance, neither the U.S., but particularly not the Chinese market, would have done so well. So this is one of the many, 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 many variables that impact the performance of the market, but not a primary one, particularly as you extend that from a day to a month to a year and to 4 years. And this year, what's the date today? It's around mid-June or so, and the U.S. market's relatively flat. So, it's not, it might be up or down a little bit, not that much at all. But here's what's fascinating. If you look at the countries that we are kind of targeting, a lot of folks are saying, well, they're going to suffer because we're going to impose tariffs on them. And we already have imposed tariffs on them. And you take, for example, Germany. Well, Germany, year to date, if you look at the MSCI index, is up about 30%.
Yeah.
You look at Canada. Our friends to the north, the friends that, they're up about 14% or so. You look at China, up about 17%. You look at Mexico, 30%.
That's hilarious.
Which means,
if you think that tariffs would be so devastating to their economies, why are all they crushing the U.S. stock market?
So all this information you gave me, I have nothing to do with it, other than just stay my current investments.
That's the key insight here. Stay the course, because all successful investors work with an advisor who help them kind of figure out what their financial goals are, create an asset allocation for them. And that allocation might not have known that tariffs are coming, but they knew at some point something might happen to the market. And I think the best, the folks who tend to have good outcomes in investing are the ones who stick to that plan, and they make adjustments not because of what happens in the market, but more of life situations. But they stick to the plan, and they talk to their advisor about this. And I think advisors at this point in time, they have an amazing value that they can bring to the table, because I keep thinking of advisors being like firefighters. When things are looking good, and not a big deal, like you're getting ready and you clean the equipment and all this stuff, but you really earn your keep when there's a fire. And we had fires in Los Angeles over and over, and people are saved by these firefighters who jumped in the burning home and saved their lives.
Well,
and I think that advisors are like this. They're like firefighters for somebody's wealth.
Apollo, that's I don't know if I 100% agree with the firefighter analogy with the advisor. I think it might be an overstatement.
Or at least as good looking as the firefighter.
Okay, but most advisors I know have no mustaches. So anyway, we want to thank you.
And Apollo Lupescu, do you have a website if people want to learn more about what you're doing? Is there a way to, how do people follow you?
Always. I mean, I just follow you all through because we stay in touch a lot. But I know I don't have my own website. I do work for an investment management company, and it's been a privilege to actually work with Allworth as part of that organization. But again, I mean, okay. I don't personally have, but I always just say Allworth advisors have a way to reach me. So
all right, we appreciate you. Thanks for being on the show.
And I had no idea you liked maple syrup that much. I mean, if you look at Apollo, he's like I think he swims or plays water polo or something. He's super fit looking. Does not look the kind of guy who drinks maple syrup.
Like Buddy the Elf when he put it on the spaghetti.
Yeah, anyway, so it was great having him on the program.
We're going to do one of my favorite segments called House Calls. And this is where we actually visit with someone that we apparently gave some excellent advice to previously.
I don't know if we did or not, but
and we just follow up with them to see whether the advice was good, bad, taken, not taken, how it turned out.
Yeah. So this past April, we spoke to a woman named Tina, a podcast listener. She's not an Allworth client. I think we have to say that for disclosure purposes, because if she is, then it could be considered a testimonial, and then all the kinds of regulation stuff. Anyway. She wanted to know how much of her net worth should be in company stock, her employer stock. So here's a clip for that call, and then we're going to talk to Tina.
My husband and I are later career, and we've been pretty focused and intentional savers, leveraging our company 401ks and other savings opportunities, et cetera. So we have we can retire, and we think, our financial advisor says live to well beyond 100 and not worry about it. And,
you're at that point today?
Down that path. She says yes.
Okay.
We're prepared to work for another year or two,
okay.
Before we go.
And what's the dollar amount?
But the amount in this.
Yeah, in the 401ks, IRAs, the overall.
Yeah. So
if you put it all in a suitcase, how big would the suitcase be?
Yeah, it's about $3 million in qualified funds, another, $2 million in non-qualified after tax,
mm-hmm.
and and then I'd say another 25% of our total in this stock. And it's a private company, and it's done exceptionally well. It has a great trajectory, but it makes me very nervous.
Do you have any
because
liquidity option in the company? Private companies, you don't always have an opportunity to sell it.
Yeah, about twice a year they make an offer to buy back.
Okay, so the 25.
And what industry is that in?
Aerospace.
Okay, so the $5 million, 1.25 million is in your company stock. Is that correct?
No, it's an additional 25.
Okay, thank you.
No.
Oh, thank you.
Yeah. So it's a bigger.
And is
number.
any of it held in an ESOP, or is it all individually held?
The majority of it is in just individually held. It's not in any like tax favored status.
And there's not okay.
And how close are you to retirement?
Let's just say a year and a half.
Let me ask you this question: If the stock went to zero, would you still be able to retire in a year or two?
I think we might put it out for another couple of years.
You want to?
I think we could. No.
See, I mean, the concept behind diversification is it's not designed to get wealthier. It's designed to protect where you're at, right? So when we're young, working for a growing company, like, yeah, maybe I've got more in there than I was prudent, but I'm taking a chance on it. If it works out, great. If it doesn't work out, that's all right. I'm still young. When we get to retirement age, particularly when retirement's right around the corner, for most people, they're more concerned about maintaining their lifestyle than they are about becoming wealthier. They don't want to go be poor, right? That's when diversification comes into play.
What's the family income?
Right now, with both of us working, let's just say in 400 or 500K a year.
And so all of this is gain in this. So how old are you guys?
I just had my 59 and a half birthday.
Okay.
My husband's about 6 months older than me.
Birthday.
So here's the thing that I look at too is the tax ramifications. So
Of course.
right. So if you wait until after you retire and you start liquidating these, right, dollars.
Yeah.
Is there any pension income anywhere?
No, we have IRAs and 401ks, but not a.
And your non-qualified, are there any stocks that you could sell at a loss? Anything that can trigger a loss there?
We do that when there is opportunity. We don't have anything right now.
And you don't have any loss carry forward from that.
Yeah.
It's a tough
A
one.
little bit.
Yeah, this
but
is really.
nothing
I
that
gotta.
would cover this off.
This is. Oftentimes if you don't know what to do, you just split the difference, and then you're right either way. But this one, because of the taxes and retirement's so close.
Because if you were retiring in December of this year, would say, okay, the next couple of years, we're going to have a strategy of reducing your exposure to this stock, and we're not going to take any income from your 401ks or IRAs. We're going to make sure your non-qualified tax is managed in a tax-efficient manner, so we can pay a very low capital gain tax on this.
Yeah, and if your income wasn't as high as it was today, I'd be inclined to.
Right.
What's your family income today?
4 to 5. So I'd be inclined to hold it. So when you said it's 25% more, right? So you've got almost $1.5 million in it. Yeah, you got $1.5 million in it.
Times 2.
Oh.
It's a lot. Yeah, it's a lot.
Oh. I'd start paring it down.
And how's the value today versus 6 months ago, a year ago, 3 years ago, 8 years ago?
It's like a rocket ship.
I'd start paring it down.
Just keeps on going up.
I'd start paring it down. Either that.
Because nothing goes straight up forever.
Either
right?
that, or I would actually pick a similarly publicly traded stock and do put options on it to give myself some downside protection.
Which is essentially, put options. You're paying a premium that
that if it goes down in price, you get paid. And what you're doing there is you're trying to identify companies that are in the same industry that do the same thing that actually will help you. If that's so, you're getting a sibling stock, if you will. So you're using financial instruments that give you some downside protection, and that you're paying that premium so that you can take advantage of the tax ramifications a year from now. And your advisor may or may not.
Is this aerospace company affiliated with a billionaire who has other companies? Put option using what?
A similar stock.
But there's no similarity to that company.
Just because of the guy that runs it.
Yes.
You're
Who's
right.
brilliant.
Which is, listen, what makes you good makes you bad. Yeah. Yes. I'd pare it down. Tina, thank you for joining us again.
Yeah. As you can tell, listen to the call. It's like there's no
equal.
You're less than a year from retirement. What steps did you or did you not make this last several months?
Well, this is a story of the value of financial advice. So this is a plug for what you guys do, and I'm appreciative of the help. But here's basically, I think I mentioned that there are probably twice a year the company makes an offer to buy employee stock and reevaluates the stock every time they do that. So just the timing, and I think it was around August, we put in to sell a portion, about 30%. We got about 25% of it liquidated, and that was kind of in the mid-high six figures, all of it basically taxable because the basis was so low. So we worked with a team of financial advisor, accountant, lawyer, to determine a tax strategy. And ultimately we set up a CRUT, and there was no transfer in kind. We actually had to liquidate it and take that whole hit. So we decided to take a couple other stock holdings that we've had for 15 plus years, similarly situated from the tax buildup, do a transfer in kind to the CRUT, as well as the proceeds from the company stock, to set up our legacy giving and to create a little additional source of income in retirement.
I love it.
Beautiful.
And CRUT is a charitable remainder unit trust. And did you have a particular cause or charity already in mind ahead of time, something that was near and dear to your heart, and this was an easy one, or did you kind of have to think like, where do we want to have these dollars go ultimately?
Yeah, well, we've been on a journey of generosity, which is really wanting to share, in our, we feel super blessed by what we've been able to do in our careers. And
are you part of generous giving? Is that where you get the terminology?
Mm-hmm.
Oh, yeah.
Yeah.
I've been to their conferences. And
So it was our financial advisor who said, you should think about giving from your wealth, not just from your income. And that kind of blew my mind. And here we are. So it's been a journey.
So let's walk through the mechanics, Scott, of what Tina did for the rest of the listeners. Because you couldn't take this SpaceX stock and actually move that into the trust because of how it was actually positioned.
It's not a publicly traded company.
What you did is you took something that you had a lot of appreciation, and you did the same. Therefore, you've got a tax write-off to offset some of the gain that you actually recognize in the SpaceX stocks.
If not, maybe all the way she structured this.
Yes, in the same calendar year, and then in doing that, you also provided a little bit of a stream of income. You still have to have a charitable intent. Don't think that
otherwise it doesn't work.
It doesn't work. So people come in all the time like, oh, my friend did this and they get all this money and they avoided all this taxes. And I'm like, if you don't have a charitable intent, it doesn't
And not
work.
everyone has charitable intents.
Yes. But what you did is you used the tax code to your advantage and fulfilled. You and your husband had to feel great about this. I got to believe, right?
Yes. It's like I would have never imagined that this would be something that we could do. And we're so excited about it.
I'm so happy for you.
So are our kids. Our kids are, completely on board. So that's the good news.
Have you involved your children in the giving at all? In selecting the charities?
Yeah, so ultimately they will have some say in after we're gone in terms of where it goes. We have it kind of categorized, but there's some flexibility in terms of specific charities that they may want to give to. But we raise them with the idea that the concept of a tithe, and that you've been blessed with it much, you bless others by giving back.
So I'm going to share something with you, Tina, that if Scott and I have been doing this for quite some time. What you just did 20 years ago, that was for the wealthy, like really rich, to have access to attorneys and accountants and a financial advisor that would have structured that. You're wealthy, but you're not super wealthy, right? And
right.
Well, there's always someone with more.
Well, it's like
you talk to someone with $100 million, they don't feel wealthy.
Well, it's like driving on the freeway. There's always someone in front of you. But what you said is you brought the accountant together, the financial advisor together, and the estate planning attorney together in order to structure this, right? And I'm guessing that the financial advisor was probably the quarterback of this.
Yes. Yeah.
Right.
You got a good advisor,
and you've got a great advisor, right? And it like firms like ours. That's why we bring tax and estate planning when appropriate in house, and when it's appropriate.
And a good advisor is someone who is helps somebody get clarity on what's important to them and design the finances around that, which is different for everybody, right? For Tina and her husband, they wanted to be as generous as possible with this, more assets than they ever thought they were going to have or need. And so that's a perfect solution for her.
And what is the Generosity Project, Scott? You both mentioned it, Tina and yourself.
This was it's really fascinating. It's an organization that was founded, a foundation funded this organization, Generous Giving, to help people give, essentially, both to understand the philosophical reasons behind it, the spiritual reasons behind that, and the economic reasons behind it. And so this organization is completely funded through this foundation. So all the tools they put out in conferences and stuff, they want people to give more, but not to them.
Okay.
So it's really different, because usually someone's talking about, here's how to give, and they've got their own intent. Why don't you talk to our state attorneys, right? Because they want to raise their own money. This organization, they don't want to raise anything from anybody. They just want people grow in their generosity. And Tina,
had you attended one of these conferences?
I attended a small group, Journey of Generosity.
Yeah, they do it over a 24-hour period.
Very nice.
Yeah.
We didn't solve the problem, right? We just talked around it, right? But this is one of the things that a good advisor would recognize. If you were sitting in an office, in any of our offices across the U.S., this conversation would have taken. It's hard to do over. First of all, it's hard to ask someone if they are generous.
You can look at their tax return.
You can look at their tax return, but
if someone's been making $250 a year and they've nothing listed on their tax return, it's a little more complicated now because most people are standard deductions, so it's not.
But it's hard to ask someone if they're generous, because I've never had anyone say no. It's like if
they might feel they're generous in other areas of their life, but maybe
that's
not
right.
Their finances.
Well, finances, yeah. People ask me if I'm nice, and I always tell them yes. We appreciate the call.
Yeah. And that's all the time we have in today's program. It's been great being with you. And again, if this was helpful to you, forward it to a friend and give us a review.
And hit the follow button.
We'll see you next week. This has been Scott Hansen, Pat McLean of Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.